Hello and welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we step back from the noise and unpack the developments shaping credit, explore the macro forces behind them, and discuss what they mean for investors and issuers across Europe and the UK. Before we dive in, a quick reminder, we've just launched our macro credit website on KBRA.com. It brings together all of our podcasts, newsletters, and quarterly reviews into one hub designed to help you stay ahead of the macro and credit trends shaping the market. You'll find all of my recent work on there, along with Van Hesser's Forward View publications, both of which offer timely perspectives as we head into 2026 planning season. So go to kbra.com/macro credit and sign up to our publications. Now, onto this week's theme, Europe's fragile reawakening. Growth is returning, slowly, unevenly, and with all the caveats that Europe tends to bring. But it's returning nonetheless. Let's start with the headline numbers. Recent Eurostat data showed that Euro area GDP grew by 0.2% quarter on quarter, while the European Union as a whole expanded by 0.3%. On an annual basis, that translates to 1.3% growth for the Eurozone and 1.5% for the EU. Modest, but importantly stronger than many economists had predicted. This suggests that Europe may finally be pulling itself out of a long, soft patch. Now, let's be clear, these are not high-flying numbers, but for an economy that flirted with recession through much of 2024, it's an encouraging sign that domestic demand is beginning to stabilize. Inflation has eased, wages are catching up, and the consumer sector, while cautious, is spending again, especially in Southern Europe. After quarters of stagnation, this feels like the long-awaited turning point, though not without headwinds. Inflation may still be a bit sticky in places. Credit conditions are tightening slightly, as mentioned in our previous podcast, as valuations are raising concerns and demand does remain uneven. Still, the green shoots are real. Now, let's take a closer look under the hood, because the real story here is divergence. France, for instance, surprised to the upside, recording 0.5% growth in the quarter and 0.9% year over year. That's despite ongoing political uncertainty and subdued manufacturing sentiment. Most of the momentum came from services and domestic consumption. Business surveys had painted a mixed picture, but the activity indices turned out to be right. France is holding up better than feared. The Netherlands also exceeded expectations, expanding 0.4% for the quarter. Trade flows remain solid, and logistics demand is picking up after a quiet first half. Portugal, meanwhile, continues to outperform. Growth accelerated to 2.4% year-on-year, up from 1.8%. Tourism and exports are doing the heavy lifting, while fiscal policy remains relatively supportive. Outside the euro area, Czechia saw growth of 2.7%, Sweden came in at 2.4%, and Hungary managed 0.6%, all modest but directionally positive results after a long stretch of weakness. Now, not everyone is sharing in the improvement. Spain's growth, while still strong, has slowed, 2.8% year over year, with quarterly growth of just 0.6%. Ireland saw a small contraction of minus 0.1%, though, as always, Irish GDP figures need to be taken with a grain of salt, given the accounting quirks of multinationals. Then there's Germany, still trying to shake off its industrial malaise. GDP was flat for the quarter, up from minus 0.3% previously, but only just meeting expectations. The outlook continues to improve, but the real recovery story may not materialize until 2026. Germany's large manufacturing base, especially those autos, remain under pressure from tariffs and softer Chinese demand. Italy slipped slightly below expectations, growing 0.4% year-on-year versus 0.5% expected, and Finland remains the only economy with negative year-over-year growth. All in all, Europe is growing, but the pace and sources of that growth differ dramatically by country. Southern Europe looks relatively vibrant. Northern Europe, particularly Germany and Finland, remain weighed down by manufacturing softness. Well, and as it happens, manufacturing PMI data was released this week, and it tells a similar story, with maybe some positive signs for that struggling manufacturing sector. The Eurozone has now logged 8 straight months of manufacturing output expansion. That's the longest stretch of improvement since 2022, though the pace remains slow. Some countries are clearly in expansionary territory. Greece, Spain, and the Netherlands all have PMI readings comfortably above 50. Others, France, Austria, Germany, and the UK, remain just below 50, signaling contraction, but the direction of travel is encouraging. The UK notably saw a strong jump in its latest reading to 49.7, a 12-month high. Output increased, new orders are stabilizing, and sentiment is starting to turn. Across the Eurozone, inventory levels are being drawn down, and while demand remains subdued, the conditions for a slow recovery in manufacturing are gradually forming. If we zoom out, the story here is one of a region finding its footing again, but still hesitating to accelerate. Growth is uneven, but finally pointing upward. That said, the picture isn't without risk. Political uncertainty in France and the UK could still derail confidence. Tariff tensions, particularly around autos and pharmaceuticals, remain a drag. Corporate sentiment remains cautious. Many firms are still reluctant to commit to long-term investment until policy signals are clearer. So while growth is indeed returning, it's returning under fragile circumstances, dependent on the country, and reliant upon a steady policy, calmer politics, and stable external demand. Beneath the surface, though, large investors are starting to position for what's being called a European capex supercycle. Apollo recently estimated the total need for capital expenditure at around $18 trillion across infrastructure, digital connectivity, energy, AI, and, of course, defense. Europe faces enormous capital requirements, modernizing its grids, scaling renewables, upgrading data infrastructure, and boosting defense capabilities. For credit market, that means potential issuance pipelines in sectors tied to infrastructure, industrials, and technology. Think of it as rewiring the European economy, slowly but decisively. So where does all this leave us? Well, Europe's recovery remains fragile but forming. The narrative is finally shifting from one of contraction and stagnation to one of cautious expansion. Growth remains divergent across regions and risks abound, but the macro tone is improving. If this slow momentum continues, 2026 could mark the start of Europe's gradual reacceleration, an environment defined by selectivity rather than exuberance. For credit markets, that means more differentiation between sectors, between issuers, and between those positioned to benefit from the next investment wave and those that aren't. That's it for this edition of the Credit Compass. If you found today's discussion useful, follow, rate, and share the show. It really helps others to discover it. And if there's a topic you'd like us to explore, please drop us a line. We're always open to ideas. For deeper insights and data-driven analysis on macro and credit trends, visit kbra.com/macrocredit, our dedicated hub for all things macro, markets, and credit dynamics. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.